Hi, Mike L. Mahler, recovering CPA, back with this next lesson in financial accounting and mercifully brief introduction. Accounting ends with scorekeeping but begins with record keeping. The first task of accounting is to accurately record transactions. Transactions are events that change the composition of a firm's assets, liabilities, and equity. All transactions should be recorded in some system of permanent, accessible records, ideally right when the transaction occurs. There are many ways transactions can be recorded, on little scraps of paper, in accounting registers or journals, or as most businesses use today, accounting software. Such software automatically stores a complete record of transactions as they occur. Expense transactions are recorded as checks are generated. Revenue transactions are recorded via cash registers and credit card readers connected to the accounting software. Here's a simple truth. Virtually all modern accounting software lets you record basic transactions without you having to understand the underlying complexities of accounting measurements. For most daily transactions, you do not need to know anything about the accounting equation or the transaction posting rules of debits and credits I discuss in this lesson. However, end-of-period adjustments are always needed, and these adjustments need to be entered manually, which means you need to understand the basic theory and measurement conventions specified by GAAP. At a minimum, the written record should include the date of the transaction, the parties involved, the dollar amounts dispersed or collected, and the nature of the transaction. An account name or number usually suffices to indicate the nature of the transactions. The assignment of dollars using account codes is referred to as posting to general ledger accounts. Here are typical general ledger accounts. Each general ledger account should be thought of as a specially formatted record shaped as a big T. For example, think of the cash account as looking like this. The T structure distinguishes between the left or debit side and the right or credit side of each general ledger account. In accounting, debit and credit simply mean left and right. These terms are not synonymous with increase or decrease. Here is the golden rule of transaction posting. Every transaction posting must involve a dollar entry on the left or debit side of one account and an equal dollar amount on the right or credit side of another account. This does not mean that one account necessarily increases when another account decreases. An account's cumulative balance increases or decreases depending upon the nature of the account. For asset accounts, debits increase the balance and the credits reduce the balance. For liability and equity accounts, credits increase the account balance and debits reduce the balance. The logic of these rules follows directly from the location of the account in the basic accounting equation. To increase an asset account, remember that assets are on the left side of the equation, and so you record the entry on the left or debit side of the T. To increase an equity or liability account, remember that these are located on the right side of the equation. And so to increase these accounts, you record an entry on the right or credit side of the T. For revenue and expense accounts, our other two subcategories of equity, the logic is based on the principle of revenues and expenses we discussed in Lesson 5. Recall from Lesson 5 that the incurring of expenses always leads to decreases in equity and decreases in assets. Earning revenue leads to increases in equity and increases in assets. Because equity is on the right side of the equation, we record an increase in a revenue account on the right or credit side of the T account. Most transactions posted to revenue accounts are credits and are always paired with a debit transaction that increases an asset account. On the other hand, expenses are recorded on the left or debit side of the T. Remember that incurring an expense leads to a decrease in equity. Since equity accounts are decreased by debit transactions, it makes sense that we post expenses as debits. Incurring an expense also leads to a decrease in assets, so a debit posted in an expense account will always be paired with a credit transaction in an asset account or another credit to a liability account. The typical cumulative end-of-period account balances are shown here. Asset and expense accounts usually end in debit balances. Liability and revenue accounts usually end in credit balances. Remember that every transaction must involve a change in one account and an equal and offsetting change in another account so that the basic accounting equation is kept balanced. We can now restate the rule this way: debits must equal credits. Now let's practice recording and analyzing transactions. I will use the general journal format to illustrate the recording of transactions, which is the format used in making adjusting journal entries. A general journal looks like this. There's a date column for the date the transaction took place, an account column for the account name, then the amount columns that indicate whether the account is to be debited or credited and in what amount. So here's our example. Jim Morrison, a licensed pilot, starts an air transport company called Joint Ventures. The company specializes in delivering agricultural products between Central America and the southern United States via small planes. His business will be organized as a proprietorship. In his first transaction, he invests $10,000 of his own money and opens a checking account. This transaction consists of an increase in cash and an offsetting increase in owner's equity and should be recorded like this. In the second transaction, Jim leases a small plane for $1,000 a month. The entry for the first month's rent looks like this. This transaction involves an expense and an asset. Again, the fundamental equation is maintained. A decrease in an asset, cash, is offset by a decrease in equity. Remember that expense accounts are subcategories of equity and that the increase in the equipment lease expense decreases equity. In the next transaction, Jim receives his first delivery order from a Mexican farmer to ship several kilos of product from Mexico to San Antonio. He receives $5,000 for making the delivery. The entry is as follows. The increase in an asset, cash, has been offset by an equal increase in equity, revenue. Finally, Jim withdraws $3,000 from the business for personal living expenses. The entry is this. The decrease in assets, cash, is offset by a decrease in equity. Owner's draws reduce equity. Remember that distributions to owners are not expenses. Such draws are considered reductions in equity. Here is what the general ledger T accounts look like after posting the above journal entries. Notice that the ending balance in the cash account is a debit of $11,000 because the total debits of $15,000 exceed the total credits of $4,000 by that amount. So click here for the next lesson.